With Election Day nearly here, many investors are bracing for what could happen afterwards. Experts say election results often lead to market volatility.
Well, I spoke with a local financial expert about how presidential election years impact the market, so you're not asking, where's the money? Mark Henry of Charlotte-based Alloy Wealth Management says historically, investments in the market can be strange in the months and weeks leading into an election.
I like to say betting. It's not supposed to be called betting, but that's really what you're doing in the markets. They're taking advantage of what they believe is going to happen with an expectation of what that would do long term.
The CEO says emotions are the driving force behind a lot of people's decisions, but typically the markets really don't change much overall long term.
Just a lot of nervousness. A lot of this can probably be caused by people thinking an election is going to go one way or the other, and so they sell or they buy, causing volatility more. But long-term holders find that the difference prior to an election and after is literally 0.1%.
So what is the message here then for people who are kind of panicky?
Yeah, and I understand why they should be, but you have to think about where you're at in life. So if you're a 30-year-old building your net worth, the message should be standard quo. Just keep funding your 401s, keep putting money in the markets, and don't worry about the election.
However, if you are nearing retirement,
so you get a very diverse account so that when markets do things you may not care for, it doesn't affect you as much.
So how do you know you're investing for your age? Henry says that's where certified financial planners come in. He encourages investors to partner with one they trust to create a plan. You want to look at the risk and then adjust it for where you are in life. Nick?
Great advice, Jane.